India's digital leap in the informal economy masks a deeper structural drift. A manufacturing revival driven by seasonal returnees can't lead to competitiveness. Author R. Suryamurthy. The latest quarterly numbers for India's unincorporated non-agricultural sector look, at first glance, like a modest win for an economy navigating global shocks. Digital adoption is rising sharply, establishments have inched up, and employment remains steady. Nearly 39% of enterprises now use the internet in some form, a staggering shift for a sector long rooted in paper ledgers and cash transactions. Establishments edged up to 7.97 crore, employment held at 12.86 crore, and urban labor absorption strengthened. But to read this as a comforting sign of resilience is to miss the deeper, more unsettling macroeconomic message hiding underneath the incremental progress. Because the more closely one reads the NSO's bulletin, the more it becomes a story not of expansion but of adaptation under pressure, an economy digitizing out of necessity, not ambition, and an informal sector that continues to carry the weight of India's labor market without gaining the productivity, dynamism, or structural support needed to sustain that burden. The headline figure, a 3 percentage point jump in digital use in just one quarter, would normally suggest a sector on the cusp of formalization, modernization, and scale. But when that digital leap sits alongside near-stagnant establishment growth, the meaning shifts dramatically. A sector that is not adding enterprises but is rapidly shifting online is a sector responding to external pressures, customers demanding digital payments, marketplaces moving online, GST-linked compliance tightening, and supply chains increasingly requiring traceability and online invoicing. This is not a digital revolution, it is an act of survival. Small enterprises are not entering the digital economy because they are scaling. They are entering it because they cannot participate in the economy without doing so. And that distinction matters, because macro transformation cannot be built on defensive digitization. The marginal rise in establishments, roughly 3 lakh in a universe of nearly 8 crore, is too weak to signal new entrepreneurial energy. When India was growing fastest in the 2000s, establishment growth was a key impulse. Small manufacturing clusters proliferated, retail units expanded, and service businesses mushroomed in both rural and urban settings. Today's establishment data suggests a sector that is maintaining, not multiplying. Instead of expansion, what the data captures is continuity, a holding pattern. That pattern is reinforced by employment numbers. The unincorporated sector added only a sliver of workers compared to April-June, yet posted a substantial rise over last year's annual estimate. The implication is straightforward. Last year's deeper slowdown was more severe than policymakers acknowledged, and the current stabilization, while welcome, does not represent a breakout. Even more telling is the composition of employment. The share of hired workers has crept up, from 24.38% to 25.91%. This is a positive sign in microcosm. It means enterprises are confident enough to incur wage costs. But at a macro level, the picture is less celebratory. Working owners still account for nearly 60% of workers in the sector, a reminder that India's employment base remains overwhelmingly self-employed, low productivity, and vulnerable to shocks. A labor market dominated by self-exploitation cannot deliver the kind of wage-led growth that many economists argue India now urgently needs. The unincorporated sector is absorbing labor not because it is expanding, but because households have no better employment options. This is the employment elasticity trap. When formal sector job growth collapses, the informal sector expands by default, not by strength, but by lack of alternatives. The quarterly data's most visible, bright spot, the recovery in unincorporated manufacturing, also demands caution. Employment in this segment rose 7.2%, establishments 5.9%, and its share in the sector edged up. But this rebound fits a familiar seasonal pattern. Workers return from agricultural labor after the Kharif cycle and re-enter small workshops, fabrication units, repair shops, and home-based manufacturing. This is labor rotation, not labor upgrading. For years, policymakers have misread these quarterly fluctuations as signs of a sustained manufacturing revival. But the structural weakness remains. Unincorporated manufacturing cannot scale because it lacks credit, technology adoption is minimal, supply chains are fragmented, and the regulatory burden to formalize remains disproportionately high for small units. The current uptick merely reiterates how the informal sector compensates for the agricultural off-season, not how India is building a manufacturing base capable of competing with Vietnam, Bangladesh, or even China's inland provinces. The urban-rural split further sharpens the macro implications. Urban workforce numbers rose from 6.61 crore to 6.91 crore, a significant jump in a single quarter. Rural employment barely moved. This is consistent with broader macro indicators. Consumption remains powered by urban upper-middle households, rural demand is still fragile, and inflation in essentials, especially food, has periodically eroded rural real incomes. The unincorporated sector's urban skew is therefore a reflection of the deeper divergence shaping India's recovery. Urban India is adapting, rural India is adjusting. Urban enterprises are adopting digital tools, rural enterprises remain constrained by patchy connectivity, volatile incomes, and lower consumer demand. For policymakers, this divergence is a flashing red light. An economy cannot sustain long-term growth when half its population operates under rising economic stress. The resilience of women's employment, nearly 29% of the workforce, is one of the few structurally promising signs. Women's participation growing within the unincorporated sector hints at a shift towards home-based work, microservices, and digital-enabled self-employment. Yet this too has limits. Women concentrated in informal, low-capital enterprises cannot meaningfully influence macroeconomic productivity. And that brings the debate back to the core macro question. What does the QBUSC data tell us about the state of India's economic trajectory? It tells us that the informal sector, which contributes significantly to GDP and remains the country's single largest employer outside agriculture, is stabilizing after a turbulent period. But stabilization is not transformation. These numbers show a sector that is acting as a shock absorber for the economy, not as a growth engine. The macro implications are uncomfortable. A country aspiring for sustained 7-8% GDP growth cannot rely indefinitely on a sector that grows in inches, not strides. A labor market where the vast majority remain informal cannot generate the consumption depth required for long-term, broad-based growth. A manufacturing revival driven by seasonal returnees cannot deliver export competitiveness. And a digital adoption wave that is not accompanied by capital deepening or enterprise growth becomes just another layer of fragility, a digital shell over a structurally weak foundation. This is the hard macro truth. India's informal economy is doing everything it can, but it cannot, on its own, carry the burden of national growth much longer.